The views and opinions expressed in this broadcast do not necessarily reflect or represent the views and opinions of WBGR Network.
Last week we talked about understanding financial statements. Give me 1 second here. I got to clear something up. All right. So last week we talked about understanding financial statements, and it might be, a lot of reasons why you might want to understand the inner workings of the financial statements. If you're talking about investing into a company, you're talking about buying a small company, large company, medium company. If you are want to sell a company, you want to make sure your financial statements are looking real good, or you just want to assess how your business is doing. Your accountant or CPA might just give you some financial statements, and you say, "Oh yeah, nice statement," but I really don't know what they mean. So what I'm trying to do is I'm trying to really talk about how these financial statements are really set up, how you can really gain insight on how the company is really doing, and basically how you can really talk intelligently once you see the financial statements. If someone were just to put financial statements in front of you, it could be a little bit overwhelming, and you might not know the right questions to ask, the right things to really address and focus on. So let's go right to it because I don't want to waste much time. So what I did was I actually took a company here that we all know, and that's Tesla. And I'm gonna kind of show you financial statements of how they looked in the past, and I'm going to show you financial statements as far as how they look right now. Right now, a couple of years ago they weren't doing very well. So, if you look at the financial statements, they will reflect some of those things. So, again, what I'm trying to do is I'm trying to really touch on the areas that make us really come into really good understanding of these financials. So, what a set of financial statements, if they're audited, by a CPA, a CPA is basically giving you an opinion on the financial statements, whether they are really reflective of, whether they're free of material misstatement, and see if they really reflect what the operations are really doing. So I'm not going to get into the actual letter of the CPA letter. There's a letter that's always attached to the financial statements, because I really want to focus on the nut and bolts of the financial statement. So let's go a little further, and I'm going to take it slow. All right, and some people might already know these things, and some people may not. As you look here, this particular financial statement was signed by Price Waterhouse Coopers on February 22nd, 2018. So what we're going to be looking at are the 2019 year-end financial statements. Usually they take a few months to actually get the financial statements done after the close of the year. So let's just go right to it. All right. So a couple things I want to talk about before we actually get started here. If you see here, if you can see my screen, I'm hoping you can see my screen. We're trying something a little bit different this time. Instead of putting it on the overhead above me, I thought it'd be better if I kind of shared my screen with you. So in this financial statement, it says the numbers are in the thousands, and this is a concept that's a little tricky to really understand. So basically, these numbers, what you have to do is when you see the numbers and they're in the thousands, you're basically just adding 3 more zeros to the number. So let's just take the first number that we see here. Let's just take cash. So the way you read this amount here is not, it's not 3,367,914. It's really 3 billion, because the numbers are in the thousands. So I think this is important for you for us to understand here. Sometimes it'll say the numbers are in the millions. When a company is small, usually it says the company is in the thousands. Okay, so just to give you a real good example, what I'm talking about here, let me try to find a single digit. So this 100 is really 100,000. Okay, so if I go back up here, this is 914,000 at the end, but this number is really 3.3 billion. So I think this is very important that you understand that concept, especially when you look at public financial statements. Usually if it's a small business, then of course the number is going to be reflective of the actual number. So if it says the cash is 33,000, it's going to say 33,000. It won't say the numbers are in the thousands and millions or anything like that. So for a small business, most of the times you won't have this, but this is just public. These are mainly public companies that actually report like this because the numbers are so long and they don't want to put so many digits on the numbers. Can you imagine how big the financial statements would be and how hard it would be to read if they put billions and trillions on the financial statements? You wouldn't be able to really make the numbers out. So what they do is they just shorten the number and just say these numbers are in the thousands or the millions. Okay, so I'm going to show you an example of numbers in the millions too, but just hold on a second. But that's not the real thing I want to go over today. The real thing I want to go over is you see here, this was Tesla. This was back in 2017, and this is 2016. Usually when you do financial statements, there's a comparison between year to year, so you could actually say, oh, the number has grown from the prior year, or it's gone down from the prior year. So it's good to have two numbers there, 2 years there, or 2 quarters, or whatever you're looking at. The first thing I want to talk about is the balance sheet, because I like looking at the balance sheet and I like looking at the cash flow statement. Everybody kind of understands what the income statement is, and I'm going to briefly go over that. I went over it last week, but I'll briefly go over it this time. So why don't I do this? Why don't I just go right to the income statement, and I'll come back to the balance sheet real quick. So the income statement, as we said last week, it could be several names. It could be the statement of operations. It could be called the income statement. It could be called a P&L. People use different terms to name the income statement. But as we talked about last week, there's your sales that comes up first. That's this area right here, the sales area. And then they have a section called cost of revenues. And as I talked about last week, these numbers are the direct costs that it takes to actually produce these sales here. So in this case, it's the cost of the cars, the cost of the leasing, the cost of the energy generation. That's probably the solar panels and all that kind of good stuff. In this case. So these are the costs that are directly related to the product that you're selling or the service that you're selling. Okay. So once you subtract that off, you get gross profit, and then you have your operating costs. These are more like your rents. These are more like insurance. These are interest and some other things here. So they actually are lumped together here. And, the reason why it's truncated is because they're trying to give you a concise presentation of the income statement. Again, I don't want to spend much time on this because I really want to get to the balance sheet, because the balance sheet tells me, for me personally, it tells me a little bit more than the income statement does. So, and everybody understands the income statement is basically how well you did. So, you have your gross profit, then you have your operating expenses, and then you have your interest expense, interest income, and then you have your income before taxes, and then there's a tax number here. So remember, these numbers are in the thousands, so this number is going to be not 31,000. This is going to be $31 million here when it comes to, actually, the provision for income taxes is $31 million. All right. However, they had a net loss here. You see this? They had a net loss of $2 billion. 240 million. So in 2017, this company definitely was not doing well at all. And if you look here, if you go from 2015, it was 888 million, $773 million. These are losses now. These are losses every year. And then the final year here was 2017. It was $2.2 billion. These are some serious losses here. And this is what Tesla was going through at that time. And you had to have a lot of guts to really invest in Tesla at this particular moment, because they were going through all kinds of stuff in the news, and some things just weren't in the news. But as you see here, this company was not performing well at all. It was in this kind of like its beginning stages, but as you see, it really was not performing well. There are a lot of reasons why you'd be paying taxes when you actually lose money, and I won't go into those today, because that's a little bit tricky. So I'm not going to go into that today. I don't want to spend too much time on the income statement. But when you look at the news and they say our earnings for this quarter, our year, or whatever fell short of our estimates, or it was exceeded our estimates, this is what they're talking about. The net income, the net income or the net loss. This is what they're talking about when you see people on the financial news talk about whether they hit their targets or not. They're talking about the net income or the net loss number. So let's go back to the balance sheet. All right. So we know that this company wasn't doing well in 2017. And certain things on the balance sheet are going to basically tell you, before you even start looking at the income statement, whether this company is doing well or whether it's doing poorly or not. The thing is, you want to look at the cash, and you want to look at the other liquid assets. When I say liquid, that means assets that either are cash or you can quickly liquidate it or sell it or whatever, and it becomes cash. So this would be in the current asset section. So everything in the current asset section are pretty much assets that really convert to cash pretty quickly. Cash is just what it is. It's actual cash, right? Restricted cash is cash is restricted for certain purposes. All right. And then you have your accounts receivable. So if they've actually collected on some sales that they've made, it becomes cash very quickly. Now, there's a reason why they call these things the current assets, is because you get the cash for this stuff really, really quickly to take care of your current bills. So your inventory. So they had $2 billion of inventory, $2.2 billion of inventory. They just couldn't, they just kept that amount in inventory, and it might be some reason why they couldn't actually sell it, or it might be they always keep $2 billion of inventory. But the thing you want to look here is two things. You want to look at, if you look at the AR, the accounts receivable, you get to see, in 2016 here, people owed them 499 million. And here they owed 500, people owed them 515 million. So there are certain things that you can deduct from there. You can say, either the sales are increasing, right, and you just haven't collected the money, or you do a really poor job of actually collecting money that's out there that's outstanding. So, I picked this kind of statement to show you it's every business, especially small businesses, won't have every account that's on here. But if you can understand the more complicated a public company, then you can ratchet it down and understand, the basic financial statement. So, so here's what you want to look for. So these current assets here, again, that's money that can be readily available to take care of his current obligations. So let's see here. Your current assets in 2017 were $6.5 billion, right? And that's a lot of money, right? But let's come down a little bit, and let's look at the current liabilities. Again, the current liabilities work like the current assets do. These are the liabilities that are going to be due really, really soon. I'm talking within the next 30 to 90 days. So here's your cash that you will be getting over the next this actually converts the cash over the the next 90 days, this actually converts to liabilities. These are liabilities that come due within the next 30 to 90 days. So as you see here in 2017, there's certain things that are really revealing here. One is they wouldn't have enough money to take care of their current liabilities. So this could be a problem. So as you see here, as bills were coming due down here, they didn't have enough cash to really take care of their current obligations. This is a serious problem. So when you think about investing in companies, if you're thinking about buying a company, if you want to see how your company is doing, if the current assets are less than the current liabilities, that means that there's going to be a shortfall somewhere, some way, and they're going to have to raise some money. And because you're not doing well at this point, this means that you're spending more than you actually are bringing in. And this is why I keep saying that the balance sheet and the cash flow statements tell me far more than what the income statement, because what the income statement says. I want to know what your cash position is. What is your ability to actually convert to cash? So if you were trying to buy a business, you're looking at what is the business's ability to generate cash, right? Because what's the point of being in business if you can't generate cash, right? So the thing is with the income statement is it could show that I'm profitable, but if you're not collecting on the cash, then you could be pretty cash poor as a business. So I'm always looking for how quickly the assets convert to cash. So at this point in 2017, as you see here, the current assets didn't even come close to the current liabilities here. So this is the way I want you to start looking at your financial statement, so you see that this is a company that was in trouble, was in deep trouble. So what they would have to do is they'd have to come down here and they'd have to act. This is the long-term liabilities here. They would have to borrow more money. And if you borrow more money, it's going to start eating into your profits because you're going to be paying higher interest. So this is one way that I actually can look at a company and I can say, okay, let's look at what their current assets are. Let's look at what their current liabilities are. And if the current assets are far less than the current liabilities, then I know they're going to have to borrow money. And if they borrow money, you have to look at the sources in which they're borrowing money from. All right. So I start to look at their income statement at this point, and I start to look for. I can show you here actually. I start to look for how much interest expense that they're actually expending here. So if they're borrowing money on a long-term basis to actually take care of their current obligations, then guess what? This interest expense number is going to be very high. In this case, they were paying $471 million in just interest alone. So look at the interest income that they were bringing in, only 19 million, but the amount that they were paying in interest was $471 million here. So it tells me that this company was highly leveraged. It was a company that really didn't have a lot of the investment capital to really take care of the needs of the company. They had to go out and borrow and borrow and borrow and borrow again. If you look here in the prior year, the interest expense was $198,000. The second, the next year, it was 400 and some thousand. So, 400 and some million. So this tells me that they had to go borrow. So if I were to go back and look at the balance sheet, I'd probably see that the liabilities are increasing. The long-term liabilities are increasing from year to year. So if you look here under this section, under the liabilities here, look how the total liabilities went from 1 year, 16 million. Actually, it's going to be 16 billion in this case, 16 billion to 23 billion dollars. So you see how the company was going deeper and deeper into the hole here. So this is the way I want you to start looking at financial statements from now on. I want you to start looking at the balance sheet. I want you to start understanding, okay,
does this company generate cash, right? And if that does it generate enough cash to take care of its current liabilities, right? What you want to look for is if these current assets, and especially the cash, is twice as much as the liabilities, then we're looking good. This is a company that I might want to invest in, and this is a company that I might want to buy if it's cash rich, right? Because once you have cash, you can invest in certain things. You can invest in new business lines. You can invest in new equipment. You can invest in whatever you want to if you have the available cash sitting there. So one indication that a company is not probably a good company to actually buy is a company that has very little cash compared to its total liabilities, and especially his current liabilities, as I just showed you here. Now, let me flip to 2020, for example, and let's look at the top here, like we were looking before. All right, so let me do this again. All right, so this is the second quarter, the quarter that just passed in 2020. You notice a little difference here. This number is in the millions. The other statement was in the thousands. Let me tell you why. The company has really grown. So it has more digits behind its numbers right now. And so this is why in this statement, the numbers are in the millions. So the way you want to look at this is $615 million. This is $8 billion. So before, remember, they only had like $3 billion of cash. So something good has happened to this company in between 2017 and 2020. It has $8 billion of cash as opposed to $3 billion of cash. So they're either increasing sales, they're getting rid of the debts that they had. It's got to be some reason why that this cash is really has risen over the prior year. It could be they got more investment money, and so you as an investor, you start to say, how do we go from 3 billion to 8 billion? And then you got to do some investigation. You got to say, well, okay, did they get more stock? Did they issue more stock? Did they get more debt to bring in more cash, and they just kept the cash, or did the sales just boom? So here's what we do: we go to the income statement, and we try to understand the sales growth. Okay, so we look at let's just look at the total revenues here. Now, if you look at the total revenues, if you look here, the total revenues have actually gone down. But what could have happened was the costs that they incurred probably have gone down significantly, which would give them a more profitable position. So if you go all the way down here to the net income, you see here that now they're turning profits. See, this is 129 million. Remember, the numbers are in the millions here. See that? So just in this quarter alone, this is the 3-month period. It's very important that you look at these descriptions here. You see, this is 3 months. In 3 months in 2020, they generated a net income. Let's see if I can find a net income here of $129 million, right? So this is one reason why the cash, there's a lot more cash, but that doesn't explain the cash being 8 billion. Now this quarter it was 129 million. And if you look at last year around the same time in June, they lost 389 million. This is a quite remarkable turnaround here. If you look at the last 6 months of the first 6 months of the year, as you see here, the net income was $197 million. They lost in the first 6 months of 2019. You see here, they lost over $1 billion just in that one quarter. So this is how I want you to start looking at the financial statements. There are a lot of things that you can start telling just by looking at these numbers. Don't be intimidated by these numbers. They all are related. They're all showing you certain relationships here. So, so again, this was $8 billion because these numbers are in the millions. Let's just see what happened here. See if we can try to figure out what happened here. I might be able to tell you. Let me see here. So apparently there's been some increase in the borrowing. We got $26 billion here, $26 billion there. It could be that the stock, they might have issued more stock. So let's just look here. If you look here, there's additional paid in capital. This is the stock section. This is the section where investors actually contribute money. That's the best way to look at this. I'm not going to get into the details of it, but if you look here, there's additional $3 billion being added right here. So apparently there's been additional fusion of cash put into the company. That accounts for $3 billion of the increase here. So as you see here, it could have been a number of things. Increase in contributions from selling stock. That's one way to get cash. That's what it looks like here. And then the internal revenue as far as their profits were actually contributing to the increase in cash. And it's probably some borrowing here that probably increased in the cash as well. So we will actually get into this a little bit more in detail in other broadcasts, but I just wanted to give you a highlight of what the balance sheet is, what it does, and what it can tell you. There are other statements that we're going to get into that we'll get into much deeper, and we'll try to understand certain relationships. But the key thing that I want you to take away from today's talk is what the balance sheet does. It just gives you a snapshot of a period of time of a particular day. The income statement, again, gives you a measure of how the business does over a certain period of time. We can look at what the current assets are showing as opposed to the current liabilities. That's what I want you to take. That's what I want you to take away from today's talk. I want you to start looking at the cash position. If we look here for this quarter that just passed, June 2020, the current assets are $15 billion. The current liabilities, look at here. Now they're in the positive. Look at this. 15 billion here, current assets, current liabilities, only 12 billion. So they have enough to really take care of their current obligations now, which is a great thing. And this is part of the reason why Tesla's stock is like just shooting up. One, they're selling an awful lot of cars now. The second thing is they've got their debt in order now. They can take care of their current liabilities. Now, certain things you have to do when you start looking at the financial statements, there's certain things that you have to start doing. You have to start looking at the news. If you see certain patterns in the financial statements, you look at the news and you start seeing what the news is saying about these companies. And they're going to basically prove what you're seeing on the financial statements. Numbers don't lie. Numbers don't lie. So when you look at the numbers and be able to interpret what these numbers are saying, you start to understand whether you can actually invest in these companies or not. So those are the takeaways that I want us to really focus on today. Next week, I'll dive deeper. And by the time we're finished, you're going to be able to look at these financial statements or any financial statements and determine whether companies are strong, whether they're weak, whether it's a company you want to buy, a company you want to buy some stock into, or a company that you might want to sell. So I think that's good for today. I don't want to overdo it. I want to take things slow because, being a CPA, you automatically assume that people know certain things and you might not know certain things. So with that, I think we'll dive a little deeper next time. And with that, I think we're in here, and stay blessed, and I'll talk to you.
Dependable, accurate, trustworthy. TD Emery and Associates.
What is this? The IRS?
we know that your tax preparation requires more than just the basics.
Hi, I'm Troy Emery, and I've spent my entire professional career helping taxpayers in a variety of tax issues. Hi, I'm Troy Emery. Here at TD Emery & Associates, we offer a wide variety of business tax services for small and large companies, including corporations and partnerships, nonprofits, and real estate taxation. Also, we offer audits, compilations, and reviews.
Let our knowledgeable staff at TD Emery & Associates help you optimize your tax benefits today. Dependable, accurate, trustworthy. TD